Welcome to our 253rd weekly webcast. We have a special guest this week that will answer our questions, who is not only a very successful venture capitalist, but also managed the internal operations for the Google IPO when she worked at Google in 2004. Karen Rotter-Davis is the managing partner of Entrada Ventures, which invests in early-stage enterprise and industrial technology companies, where her firm partners with founders and executive teams to build successful businesses. And Karen also worked at General Electric in their venture capital division, and she's worked at several early-stage companies that had a successful exit, meaning they were acquired. And she was also the director of early-stage projects at Google. Now, at Google, Karen scaled AdSense, which she helped to grow from near inception to several $100 million in revenue. And AdSense, as we know, is now a multi-billion-dollar business for Google. She's also on the board of many companies, including the New York Stock Exchange-listed company Shift for Payments, 360 Learning, and many others. And she was also an adjunct professor at Northwestern University. Now, Karen did her undergraduate degree at Princeton University, and she has an MBA and a law degree from Northwestern University. Now, I first met Karen back in 2014 when I worked in venture capital and we partnered on a deal. Now, in addition to Karen's brilliance, she is the most affable person I've ever met in venture capital. Now, it's my great honor and privilege to introduce to you all and interview Karen Rotter-Davis. Karen, thank you so much. I'm so humbled that you're joining us today.
Oh, likewise. Thank you so much for having me, and it's great to be with you all.
Awesome. Thank you. So our first question is, a lot of my students want to work in the venture capital industry. Now, what advice would you give them to increase their chances of working at a VC firm?
So I think the venture capital industry is pretty diverse, so a lot of it depends on the stage that you're interested in. But I think in any case, you really want to focus on differentiation and operations. So by differentiation, having some sort of focus area, some area of expertise that you can offer, and also to be able to vet potential opportunities. And then the operations piece is work at a startup, work in companies, own a P&L, really understand what it takes to build and manage a business. And that will give you many more insights into how to evaluate them and also how to be more valuable to founders and executive teams. And that's just on top of then having that financial expertise that's required to vet companies, especially as they get into the later stages and you're looking at the economics of a deal.
Okay, great. Thank you. Now, what is a day in the life like for a venture capitalist?
I think it's pretty varied, it's sort of a joke, but I mean, there's a lot of meetings, but there's a lot of learnings along with those meetings. I'll meet with founders who are thinking about starting companies, who have companies but aren't ready to pitch yet, who are in the middle. I'll see a lot of pitches. I'll talk to partners who might co-invest, potential partners to kind of share deal flow, a lot of experts around what they're seeing, and that could be either for diligence or for thinking through investment theses. And then there's a big portion that's actually thinking, which sounds like, these blocks of time where I really am just thinking about my companies, I'm thinking about the market, I'm thinking about spaces that could be interesting and trying to kind of have a view on the world. So it's kind of like digesting all that information that I consumed throughout the day.
Cool. Thank you. Now, as a venture capitalist, how do you decide what companies to invest in? And what is your due diligence or research process when analyzing potential companies to invest in?
So for me, I think the most important factor is the people. It's the team. I think, and that's different for different industries, but right. For technology, a lot of that, the business model may change, the customers might change, the operating plan and the financial, they're certainly going to change. The people have to be able to navigate through that and to have the right temperament to weather that storm, to adjust vision based on feedback, but also be strong in what their true north is. So the diligence is a lot, is primarily for me, on people. Then, of course, you're going to look at what's the market, what is that tech differentiation or the business differentiation, what's that insight or that aha that's going to make the difference and make this company be successful versus others. Right. And then I'm looking a lot at how does this gel with the investment thesis? What's the problem to be solved, and what's that area that they can go after and really alleviate pain or provide like such a benefit that it's going to be incredibly compelling. And it's talking to customers. Again, it's all those meetings. It's talking to customers. It's talking to experts. It's talking to the team. It's talking to people who worked with that team before and how they act in good times, in times of stress. How I can then help them build their business.
Right, that's great. They say the jockey is more important than the horse. And one of the problems with traditional MBA degree programs is they don't teach you how to analyze the management team. They tell you to dive right in, look at financial statements. Okay, cool. All right,
yeah,
so
that's true.
Now, given your work experience at General Electric, working in venture capital, why do large companies like GE have a VC division?
That's an interesting question. I think it depends across different large companies. But I've generally seen 3 or 4 reasons. One is just to learn. They're large companies. They're sometimes very insulated, and a lot of their teams spend more time working, across divisions and in between themselves than they do looking at the outside world. And so having a venture division gives them the opportunity to look outside, to learn about new technologies, to understand markets, to understand opportunities and threats, quite frankly, to their business. I think they are interested in thinking about some strategic partnerships that will help their business. Those partnerships, sometimes they hope, will turn into acquisitions, which is, in my opinion, always a little dicey when you're trying to use corporate venture to acquire a company. It's got some disadvantages for that startup, but as well as advantages. But we can talk about that at another time. And I think some venture divisions of corporations are just looking for financial returns, maybe a little bit of learning, but they're churning off some cash, and they feel like they have some expertise and are able to put that money to work in a better way than if they were offering a dividend or they were investing it in other areas of their own company. And you can argue again whether that's a good idea or not, but that's one of the reasons they think about that. It's a combination of all those.
That's great. Thank you. Now, it's a no-brainer for startups to want to partner with you, given your early stage successful track record of working at companies that have been acquired, and also given your late stage experience as you manage the internal operations of Google's successful IPO, and you help scale the Google AdSense product. But when you compete with other venture capital firms to get highly sought after deals, how do you sell yourself to founders so that they choose to partner with you instead of another VC firm?
Well, thank you first for that vote of confidence. It's really, I appreciate that. It's fun. Venture capital, you're selling money, which is fungible. So when you're going into these opportunities, you really have to talk again about what your area of differentiation is. So that's really what I focus on. Like, what am I good at? Where is my expertise? Where have I spent time? What have I seen? How can I cross-pollinate and connect dots in a way that others might not be able to, or that they just appreciate about me? I bring a network, and that network is open to them. And so it's, that could be potential partnerships. It can be potential hiring. It can be just, seeking an outside board director or other venture capital that I can bring in a later stage that would also be a good fit for them. And then it really comes down a lot to style. And I'm not talking about, but how do we get along, and how are we may not always agree, but can we vet a hypothesis, and even if we disagree, come out with the best way to proceed, and if it doesn't work, how to turn quickly. And what is it like when we disagree? What are we aligning on? And how, we're going to be working together for the next 10 years.
Yeah.
So how does this make sense? Are we getting along? And is this somebody that you'd want to spend that time with over time? And sometimes I will say also, it's not an either or, it's an and. So if you're looking at another firm and you'd still like to work with me, how do we figure out that balance? And is there an opportunity to collaborate?
That's a great answer. Thank you. Now, given the fact that you're a managing partner at a VC firm, what do you tell your coworkers to do when it comes to using AI to do due diligence on early stage companies?
We do invest in AI, and so we're familiar with the space. And I think the best way to put it is, trust but verify.
Yes.
I think somebody, it's especially with the explosion of generative AI, that's kind of come into the fore right now. I think somebody had this great analogy, which is like, okay, summer interns are incredibly useful and they can be very helpful, but you still need to give them a lot of direction. And would you actually just take the memos they give you and run your business based on them? Right. And so the answer, of course, is no. You want to give them some oversight. You want to have a conversation. You want to have the context, and you ultimately want to assess what they're giving you and make that decision and move forward. And so AI is very similar. It's the information you're getting is a tool. It's not a substitute for work. And I go forward with that philosophy in mind. And to give you an actual case study, we were doing diligence on a company. We had done a search, and it pulled up some results that connected, just because of the company name that had been used by another company. It connected that founder with a completely random organization that was just sitting there on the page, like they were connected in some way and were running a side business. And if we had just relied on that, we would have said, oh, this founder's got a side hustle and this doesn't make sense, and so we're not going to go forward. And looking at that, saying, okay, let's check LinkedIn with all of these folks and see if they know them and who they are. Let's talk to the founder and find out, like, okay, what's going on with this? This is what we picked up. And it turned out to be completely like a hallucination, a completely false connection, a false link that if we had just relied on that would have been really sorry about that. So trust but verify.
Absolutely. These AI products are certainly confidently wrong all the time. So now, what are the top technology trends or themes that you think make great long-term investments?
So the themes that Entrada is looking at, I can tell you very, very broadly, and there's a lot to unpack because I think we look pretty widely. And it's not just themes in silos. We're constantly looking for maybe combinations of each of these. But, we talk about AI. I think next-gen computing is always a hot topic, and that's not just AI from a software perspective, but we're looking at facilitative hardware, and we're looking at beyond AI, so things like quantum computing software. We're looking at, and we have a company in our portfolio there. We're always looking for breakthrough software platforms, and those could be, in neglected, boring verticals, or just in general, insights and productivity gains that again are undiscovered or undervalued or underseen. We really like materials and materials management or manipulation, and so that can include the software component and also the materials themselves. And those have lots of applications across multiple industries. And then there's a lot of attention, or there should be a lot more attention paid from, we call it bits to atoms or built environment or digital to physical. And it's, adding that technology and software piece into the real world. And so that includes some climate tech, as people are talking about now, but it's not exclusively so. But those are the general themes that we look for. And I can always get into specifics on certain verticals I'm excited about.
Awesome. Thank you. Let's talk about your work experience at Google. In 2004, you managed the internal operations of the Google IPO. Can you please talk about your experiences with Google's IPO, as well as the criteria for a successful IPO from an execution perspective?
Mm-hmm. Well, I what an incredible historic opportunity. So I was so grateful to be able to, to be a part of that. And at the time, it was almost made for me in that it connected that legal experience and understanding the legal requirements of taking a company public with all of the kind of consulting operational experience I had and that sort of mindset of, okay, here's the requirement. What do we need to do to get this in motion? And so, if you were that was the one to be on, in my mind. I was like, I was so grateful to have that opportunity. I think in terms of what makes a successful IPO, I mean, let's just set aside first, you have to have the fundamentals on the business side and everything lined up in that. No operational execution is going to take the place of good business fundamentals and a company that's really financially ready to go out to the public markets and ideally sustain the stock price in those public markets. From an execution perspective, taking a company public, it's years in the making. There's a lot of taking a company public there's a lot of systems and controls and transparent reporting and a lot of sort of infrastructure that needs to be put in place to make sure that you're able to satisfy the requirements of becoming a public company. And so looking at that kind of from, your time of going out public all the way back, I mean, the rule of thumb is sometimes 18 to 24 months to set those things in motion. As for the actual then going public, it requires really good project management, communication, and again, really having that eye towards sequencing of all those requirements and getting it out there, not just for the day that you go public, but, understanding that you've got your first several quarters kind of lined up to make sure that you can sustain the momentum of heading out. And I would just add the other thing that I was grateful for, and I think really appreciate even more in hindsight, was how much the perspective of the company was important. This was not the end in itself. This was a milestone in the company's life, one of many. And I think it showed in that you see, among many factors, just that mindset set it on a trajectory to be so successful going forward. Like this wasn't the end. This was the beginning of a new kind of chapter in the company's history. And managing that culture, when you talk about the execution, managing that transition from going to a private company to a public company is also really important. In a lot of ways, you get more transparency into the public markets and you have to provide more reporting. But as a private company, you are allowed internally so much more leeway in terms of the information you can share and when, interim revenue projections and things, where when you're public, you can't do that. You also don't have as much upside in your stock. Once you're a public company, it's going to be, hopefully it continues to grow, but that big ramp from becoming a small startup to a public company isn't there anymore. And so that means you're relying more on cash to incent people, which is a very different business and risk profile of you managing the business. So understanding that transition and that cultural transition, in addition to the financial one, is also really important to navigate.
That's a great answer. Thank you. Now, I remember during the IPO, which I participated in when I worked in the hedge fund industry, Larry and Sergei mentioned, "Don't be evil," from a corporate ethics perspective. Please share with us what they meant by that statement.
That's funny. I say that's funny because my recollection was that it was never really meant to be something external. It was said in a meeting as almost an internal gauge or sanity check on really doing right by our users and our customers, and building and maintaining trust and keeping a long-term view on things, as opposed to short-term. Again, you talk about going public, quarter to quarter pressure versus thinking over the long haul. what's really important. So it became this, again, it was thrown out kind of informally as a sanity check on, okay, that might get us some short-term gains, but is that really going to engender trust? Yeah. Is that really going to be the best for the long-term relationship for our users and our customers and our ecosystem? And I think that it definitely still holds, but I think it's certainly shorthand. And there were times that, again, that's not good for our users. We could take that data, for example, and use it in a certain way, but that wouldn't be good over the long haul. That wouldn't be transparent. That wouldn't engender trust. Similarly, we many times turn down revenue, short-term revenue, because it would endanger the ecosystem over the long term. But that wasn't what a partner might have been doing, or a prospective partner was going to do, wasn't healthy for that ecosystem. So that's kind of, again, the philosophy that I would say that it spurred.
That's great. Well, as Warren Buffett said, the longer the view, the wiser the intention. It's great to be long-term focused. All right, next up I've got, what advice would you give my students when it comes to trying to get a job at a technology company like Google?
Yeah, I think first do your research. So there's so many opportunities to join technology companies in so many different roles. So start looking at those titles and the requisitions that are most interesting to you as they're posted, and look at those skills that are required and the attributes that are required, and sort of say, okay, how do I build those skills? Where can I get that experience? How can I make myself most useful if this is what I want to do? And kind of build to that. And that could be through internships. It could be through doing your own thing. It can be through coursework, through classes online, through such as right here, and kind of build that resume of where you want to go that matches those opportunities. And then there's the networking piece. The time, if they have job fairs, if you know people who are there and can give you advice, reaching out to your network for informational interviews, just to learn more, because sometimes they'll say, oh, there's no opportunity now, but here's 2 people you can talk to, or in 6 months we'll have this opportunity, or maybe give you some insight that's not public on the requisition that would be really helpful for you to learn. So the combination of that self-learning and book research and online research, coupled with talking to real people, is always a formula for success, no matter what you're trying to do. It mirrors a lot of what I do on the venture side, right? I'm doing a lot of research, I'm thinking a lot, and then I'm talking to a lot of people to further my knowledge and also further the opportunities of exposure.
Yeah, and networking is key for getting a job. It's fascinating because for every job opening you see online, you literally have a 1 in 250 shot of getting that job. And the person that gets the job usually knows somebody at the company. So it all comes down to networking. Yeah, great.
Yeah.
Now, after you left Google, you worked at a startup called Urban Engines that Google purchased. Now, from an M&A perspective, why do large companies buy versus building the product themselves?
That's a great question. Again, it really depends on the company, but first and foremost, companies will get bought because there's some strategic value to them, and that could mean that there's some technology that's hugely enabling to them, or it could mean that it's something that's hugely threatening to them, or it can mean that there's some sort of optionality or contrarian view. Like, okay, we're going to hedge. We've got something here, but we might want something just in case that doesn't work out. But the build versus buy, companies are always looking at, first it's like time to market. Will it take us longer to build it versus buy it? And there's always a debate, and it doesn't ever take the time on both sides that you think it will. It always takes longer on both sides. So it's measuring that out. The other, of course, is cost. So all right, what is it going to cost us to build it versus what is the cost of acquiring here? And again, people will debate that internally, but that's the other consideration. And then the third point is sometimes talent or expertise. A lot of times companies don't have the expertise in-house, and acquiring a company and hopefully retaining that talent, which is another consideration when you go. It's not just buying it, it's how do you integrate that team and how do you retain all of that talent is going to be critical for them to move the business forward. So those are just some points, and you always need to balance, and it rarely turns out as planned, but at least you understand the potential roadblocks and opportunities.
Yeah, that's great. Thank you. Now, if you could go back in time to when you graduated from Princeton, what career advice would you have given yourself?
Oh gosh. I would talk to more people in the moment. And I think, when I went to school, when I grew up, where I grew up, I really wasn't exposed to a lot of opportunities on the career side, certainly in the business sector. Most of the folks that my friends' parents and my parents, they were teachers, policemen, firefighters, so I didn't know anybody who was in business. And it wasn't until college where I got exposed a little bit to it through the college recruiting process. But I feel like if I had talked with more people or been exposed to more people doing different things, I might have wound up in the same place, but I at least would have found, had some more ideas about how to connect it all together. Yeah. That might have helped me accelerate some things, or it just given me a different outlook. So that's one thing I would say. And then, we talk about networking. I said, I probably would have told myself, be more intentional and not as intimidated about building relationships and networking. Yeah. And I think, I probably went into it a little bit shy about reaching out or just being curious and learning from other people, even if they looked intimidating to me, or I was, the little nerdy kid, and, they looked super cool. So I don't know, but I probably would have just put yourself out there. It's okay. The worst thing that happens is they don't talk to you and then you move on. Nothing ventured, nothing gained. Yeah. So that's probably what I'd say.
Well, that's a great answer. Well, I know that relationships are often more important than product knowledge, and your network is your net worth, and networking is everything. It really is. So, Karen, thank you so much. Now, let's take some questions from the audience.
Great.
All right. Let me scroll right to the top here. Give me 1 second. It's fun doing these things live. All right. Yeah. First question I've got is from Robert, who's asking about what are your thoughts on the impact of the failure of Silicon Valley Bank on the venture capital sector and technology startups in general?
So, thanks, Robert. I think it was such a shame. Silicon Valley Bank was really such an integral part of the ecosystem. They were great partners to so many startups and really understood startup finance in a way that I don't know that other banks did. Now, they've certainly made other mistakes, obviously, and then just got really stuck in this rapid interest rate rise that we had that was really unprecedented over the past several years. But I think as interest rates normalize, we will continue to really miss them in terms of there will be a gap in terms of that ability to provide venture financing, venture debt, and understand really startup ecosystem and what that takes. Hopefully folks, I think, have found homes elsewhere and they can maybe replicate some of that knowledge. But I think that's the biggest impact, that you're really missing a player that was a true partner and really understood startups and how to create debt financing instruments for them.
Yeah, it's fascinating how quickly it all ended for SVB. In the past, if you want to take your money out of the bank, you'd line up. But now, given mobile banking, people were withdrawing the second they heard the rumor. So it was shoot first, ask questions second, which is unfortunate.
Yeah.
Okay, next question is from Brian from Virginia, who wrote, why did you choose to enter the venture capital sector?
I circled around it for a while. Ultimately, I love learning. I love helping founders. I really enjoy building. And over time, I feel like I'm sometimes a better coach than, or I want to be more in that coaching position than I want to be a player. And so, venture capital works for me for that in the early stages, especially because I'm helping founders to figure it out. I'm learning along the way, and I'm taking that knowledge and I can apply it somewhere else. Where sometimes from an operational perspective, if you're in that role, it's just all consuming and it's really hard to get out of it. So my personality is I need to make those connections across. So I probably would be in some cross-functional or C-level CEO role where I could make those connections and hold that. But the idea of being at one company right now, I haven't found the one. So for now, I really like having a portfolio and coaching those folks who I can to build their own really successfully.
That's a great answer. And there's a great book called Give and Take. And the author analyzed and understood that the most successful people in the world are givers like you. So that's awesome. In terms of books, speaking of books, follow-up question from Brian, which is, what books would you recommend to read about your industry?
Oh gosh. Well, Giver and Taker, Givers and Takers, that book by Adam Grant is terrific. Yeah. And his work in general, I admire. I think Brad Feld has a kind of a primer on how to know more than your lawyer, and it's from a founder perspective. But I think if you're going to go into venture, you learn it from both sides of the table. So I think that's a great opportunity to really learn the nuts and bolts of venture financing. Right. So that's one that I would recommend. And I think, I love Kim Scott. She was a wonderful coworker when she was at Google with me, and she's out with several books. Radical Candor, I think, is one to whether you're working on managing people or you're partnering with executives and trying to manage. I think is that's just a really interesting critical framework to keep in mind. And then the other book by another fellow Google alum, Claire Hughes Johnson, on management and scaling, I think is terrific. And again, that's more around people. It's not the nuts and bolts of venture financing, which you can get from anywhere. But that advice in that book is it's a great read.
That's awesome. And how do you keep up to date with technology trends? Are there any websites that you read often, or other books, etc.?
Yeah, I read a lot. I just consume general media, so news media, so I can understand trends, what's happening in the world, not just in the U.S., but really globally, and those implications in different places, who's leading in different industries over the world. And then, I'll look at tech trades. Like, I think I like MIT Technology Review, just overall. I think they do a terrific job. That's one I look at. Some of the tech trades, Axios does wonderful sort of kind of industry specific newsletters that I really like. Quartz is another one. Quanta, they do good jobs, I think. And then I'll look at different newsletters from people that I just find interesting that I've met over time. Some of them are in AI, others are just more general. Or papers. I'll look at papers that have come out, like research papers, and then I just talk to people. I really if I'm reading an article about a professor and they came out with something interesting and they had something insightful and they were quoted, I might want to, I don't just go to them and knock on their door. What can I tell them that might be interesting, or what can I share, and then what can I learn from them? And so it's an exchange. But yeah, it's that, again, combination of reading and talking.
Yeah, it's the whole give and receive thing. I love it. Great. Next up, Manas from India wrote, what are red flags that you see that cause you not to want to have a second meeting with an entrepreneur?
There a lack of self-awareness. That's a huge red flag. And so, are they listening, or are they just have their pitch and they're sticking with their pitch? So that's a subset of a lack of awareness. But can they read a room? Are they getting feedback? How do they respond to a question or a contrary view? All of those things I'm trying to gauge from that meeting. And if there's just this blanket lack of self-awareness or kind of ingestion of new information and response to that, I'm out.
Yeah. Fascinating. Well, I once met a top venture capitalist that I partner with, and he told me he asked one question. And if they answer it wrong, the entrepreneur, he doesn't invest. And that question is this: do you have a plan B? And if the entrepreneur says, yeah, I might go back to business school or go work in consulting, he doesn't invest. The answer he's looking for is, I don't have a plan B. I am all in. Yeah.
Right. Yeah.
Interesting.
That's true.
Okay. Let me see what other questions we've got here. Give me 1 second.
Sure.
Next question is, how should entrepreneurs go about raising money? Like before they meet with a venture capital firm from high net worth investors, how should they sell themselves?
Got it. Well, I think again, it's a mutual sale. So you don't want just any money. You really want investors. Ideally, you would get a choice. Sometimes you feel like you don't have a choice and you're taking from whoever will give you money. But again, you run a risk of actually being worse off with predatory terms or with investors who aren't ethical or have done terrible things or going to be not helpful and not credible and undermine your ability to raise from venture, who will make your capitalization table so take too much or make your capitalization table so wonky that it actually discourages investors from putting money in. So I think going with experienced angel, like friends and family, so people you trust and they understand that they might lose this, but they believe in you. That's a great way to start. And then really networking to people that are experienced angels and ideally with connections into the venture community, who know what good looks like, who know what standard kind of venture attractive companies look like, who will also speak with you about making sure there are concrete goals and you're getting enough money that you can get to a milestone that is attractive to venture. So that would be my advice. A lot of folks just raise and there's no end point in mind, and they just wind up keeping that safe open or the convertible notes and being diluted, and it just looks it kills the company before it even gets started.
Yeah, that's a great point. All right, our final question is from Adrian, who wrote, what, in your opinion, is the most misunderstood aspect regarding venture capital or venture capitalists?
So, all right, I'll take this from a couple of angles, so I might do two. But I think we meet with thousands of companies a year. We look at thousands of pitches. We probably meet so we look at thousands of pitches. We don't meet with thousands of companies. We meet with a handful of companies, and we might invest in or two handfuls of companies, and we invest in a handful of companies a year. The amount of companies that get funded is actually relatively small. And so really understanding that taking a meeting does not mean you're going to get funded.
Yes.
And
exactly.
And then even it's not done until your documents are signed. Getting a term sheet doesn't mean it's going to happen. So really understanding that process. And I think understanding venture math is important too, whereas you might have an incredible business, but really understanding who you're pitching to and the mechanics, the fund mechanics of that venture capital firm is really important. And I think, if I'm a seed stage fund, my ultimate goal is, my ultimate job is to return money to my investors. I need to make a profit and an incredible profit, ideally, for my investors. And to be clear, we're not always talking in venture capital about rich people getting richer. Again, those teachers and firefighters and policemen and nurses, like, they have pension funds that are invested with us. And there's a duty for us to return that profit and make sure that they can get the retirement they deserve.
Yeah.
And so every company at the seed stage that I'm looking for has to return. I'm looking for 100x return.
Yeah.
100x. Everyone. So I can make sure that I can return to the LPs that I need to. So when I look at your business and you come to pitch me and you're telling me that, you have a certain market size, which could be healthy, or you're telling me like, yeah, you got this and you're going to like put in a couple years work, again, to Chris, to your point, like all in, right?
Yeah.
I'm going to put in a few years and then I'll get acquired for, a couple of $100 million. Well, if that happens, that's nice. And obviously life changing for you, but that doesn't help me if, after putting a certain amount of money in and getting diluted and going all the way forward, like that won't be a game, that won't help me and my investors.
Yeah.
And so understanding that going into the meeting and what you need to prove to make a compelling case to me is really, really important. And I think it's very misunderstood by a lot of founders or prospective founders.
That's a great answer. And Karen, thank you so much for your time.
Absolutely.
Your life story is so inspiring and you're so generous as well. And, from a giving and taking perspective, I see why you're so successful. Thank you so much.
Thanks for having me. Thank you all. Great to be here.
Take care. Thanks. Okay, let me go to questions. So that was amazing. She's great. Yeah. And I recommend everybody read that book, Give and Take. And basically that book, I'll summarize it for you. The richest 1% of people in the world are givers. And most other people, the other 98%, are takers. And the poorest 1% of people in the world are givers too, people with beautiful souls like Mother Teresa. But the richest 1% are givers. Give and you'll receive. It's prophetic. It's been true since the beginning of time. Help people. And when you set up networking meetings as well, always think about how can I help that person I'm about to meet with? And people are usually motivated by three things in business. Number one, they want to make more money. Number two, they want to get promoted. And number three, they want to enjoy what they do. And so before the meeting, these networking meetings you do with people, think about how you can help their career with one of those three attributes. Okay. All right. Let me go here to questions. Okay. Okay, so Robert wrote, has the higher Federal Reserve rates curbed VC acquisitions to higher ROI deals? Yeah. So in general, I'm sure you all saw the news flow in the past couple of days. There were three things that are causing the Federal Reserve to consider cutting rates next year. Number one is unemployment is slowly increasing. Number two, inflation is decreasing. And number three, retail sales from the most recent month were negative for the first time since March of this year. But generally speaking, whenever rates go up, alternative asset classes don't do as well. And the best example of this is an extreme example in the early 1980s, when the Federal Reserve raised interest rates to close to 20%. Nobody wanted to invest in anything but debt. Why buy venture capital investments or buy stocks when you can make 20% in the bank? And so generally speaking, that is why when interest rates go up a lot, all other investment classes go down. But again, I think that we're going to see Fed rate cuts starting next year. Yeah. Okay. Good morning, Kevin. How are you? Carolyn, great to see you as well. Hope you're feeling better. Okay. Give me 1 second here. Okay, Marcella, how are you? Marcella wrote, "Good morning, Chris and Karen from Portland, Oregon. Thank you for the interview. Always great to see you. Always great to see you. And it's great to see you at our graduation event this past summer as well." Okay. Next question is, let me see, a lot of these questions were for Karen. Give me 1 second, please. Okay, next question is from Victor, which is, what kind of professional qualifications do you look for in candidates? Would you rather have a CFA or a chartered accountant? Yeah. So I think that a CFA is more valuable than an MBA from a finance perspective. And for those of you not familiar with the CFA, it stands for Certified Financial Analyst designation. And it's an exam that you take. There's 3 exams actually you take over 3 years to get that designation. You learn a lot more about finance there than you would in an MBA. And level 1, part 1 of 3 of the CFA is basically a repeat of the finance stuff you learn in business school. I would say knowledge of accounting is really important as well, because one of the things that's not common sense in business is accounting. And that's the language of business as well. And you have to thoroughly understand accounting before you can scale a business or even understand finance for that matter. And finance it's more of an art. It's forward looking to the extent that you're forecasting the future. Whereas accounting is more of a science. It's backwards looking. You have to be precise. But when it comes to degrees and professional education, I think it only matters when you get your first job. After you get that first job and you scale your career, it's much less important. And the reality is that I think most universities are going to go bankrupt in my lifetime because you can learn so much more online. Obviously, I'm biased, but you can learn so much more online and up-to-date stuff that you can implement in your career immediately. And in the future, I think that people are only going to go to university if they get into a great brand name, like a Harvard or Yale, for example. Otherwise, why waste the $100,000 for the undergraduate education? Yeah. And of course, I'm biased because of what I do. All right. Next question is from Eric from Florida. Eric, who wrote, "What's the difference between small companies versus large companies?" I would say at small companies, you kind of have to be a jack of all trades. You have to be able to do everything quickly. And it's obviously much riskier as well. I recommend that when people graduate from school, they don't go to a startup. They go to a large company as well, because that's kind of an extension of your education and it's resume building as well. And I can talk a lot more about that if you have follow-up questions. Thank you. Okay. Sean wrote, how do you recommend somebody build their network with the intention of acquiring and growing small, locally owned businesses? Yeah. So when it comes to networking in general, people will meet with you if they have something in common with you. And so what I recommend doing is having an up-to-date LinkedIn profile and network with people that have 1, 2, or 3 things in common with you. For example, reach out to people that went to the same high school and live in the same town that you live in. And so for me, I was able to get a lot of networking informational meetings from a job search perspective by finding people that are also from Mississauga, where I'm from, and also who went to the Toronto French School. And people want to meet with you. All you have to do is ask. And it's like dating. You never get married after one date. You have to date lots of people or ask a lot of people out. The same thing with networking. You will get a lot of rejections, but one great meeting can certainly change your life. Yeah. And the way to think about it is this. You might think to yourself, why the heck would somebody take a networking meeting with me? Well, think about this. It's 20 years in the future, and you're 20 years more successful than you already are today. And somebody 20 years younger than you reaches out to you that's from the same hometown, maybe they went to the same school, and they ask you for a networking meeting. Would you take that meeting? Of course you would. And so relationships are more important than product knowledge. Your network is your net worth. If you want to get anything in life, you have to network aggressively. And that's the only way to get a job as well. Like, I think it's useless to just throw your resume out there online because, as I mentioned earlier in the interview with Karen, you literally have a 1 in 250 chance of getting that job. So the person that gets that job knows somebody at the company. So you have to network and network aggressively. Yeah. Okay. And then Marcelo wrote, great questions and awesome answers. Karen is amazing. The information provided here is very down to earth and extremely valuable. Thank you. Thank you. Next up, we have Fred. How are you? It's been a while. Fred Mendoza from DC, who wrote, hey, Professor Chris, great to see you. Why did you go from hedge fund to venture capital? And were you ever in the private equity sector? Yeah. So the hedge fund sector for me, I found was too short-term focused. You know, every month has 20 weekdays, meaning 20 days the market's open. And I wanted to be much longer-term focused. And stocks go up and down in a short amount of time for random reasons. You're often fooled by randomness. And I think the best investments you can make are very, very long-term focused. And people think that all hedge funds are short-term focused. That's not true. There's the Tiger Cubs, meaning companies that are hedge funds that came out of Julian Robertson's Tiger hedge fund in the 80s that are very long-term focused. But for me, what I started doing in my hedge fund that I started investing in venture deals. And my first venture deal that I did was actually in Facebook. And so I morphed my firm into a venture capital firm. And I loved it because I was longer term focused as well. Yeah. As Warren Buffett said, the longer the view, the wiser the intention. In terms of me working in private equity, I've never worked in private equity before. No. All right. Next up, Werner wrote, hey, Chris, hey. How do you secure investment for ideas or technologies that would revolutionize an industry, especially when these concepts are mostly theoretical, but show strong potential for global impact? Yeah. So for me, like Karen mentioned earlier, it all comes down to the management team. I would always rather invest in an A management team with a B business model instead of investing in a B management team with an A business model. You know, ideas are commodities, but execution is not. And when we invest, and when I used to work in VC, when we invest in early stage companies, we know that their business model is going to change and the market will change dramatically in the next couple of years. It's an early stage company. But we want to know that that founder will be able to adapt or sell themselves. And the most important skill you can have, I really think, working in a startup as a founder or a big company, is being able to sell yourself. And so I look for an entrepreneur that can make me excited about something really boring like cloud computing, like Mark Benioff did with Salesforce when he launched it back in 1999, or Sir Richard Branson has done with 8 million different companies. We always invest in the best entrepreneurs that can sell, and sell with their heart as well. And they can't be doing it for the money. You know, if you chase money, you lose your money and your dreams. But if you chase your dreams and you don't give a darn what people think of you, then something wonderful happens. Your dreams come true and the money follows accidentally. And so the best investments you can make are in people that are very long-term focused, that are passionate and can sell. Yeah. Okay. Sanjay wrote, hey, Chris, hope you're doing well. Likewise. I'm wondering, what is the future of hedge funds? And will hedge funds go for more time? Or are they becoming too old? Why are they still under alternative investment? They're really not regulated by the government. They can't advertise. So they kind of fly under the radar, so to speak. Now, I think that hedge funds that will survive in the long run are ones that are long-term focused. And earlier I mentioned Tiger. So Julian Robertson, God bless him, he passed away recently. But Julian Robertson founded Tiger, which was an incredible hedge fund back in the 1980s. And he was so successful that a lot of the portfolio managers that worked there left to start their own hedge funds. And they were also long-term focused like Julian Robertson were. And we call those Tiger Cubs. You know, Blue Ridge is an example, Maverick, and there are plenty of others as well. And so in order for hedge funds to survive, they really have to be long-term focused. Yeah. And I think that only large hedge funds will make it in the long run. It's a lot harder to start a hedge fund today. Another reason I mention that is because large hedge funds are successful. They have more clout. And what they can do is when you sign the documents to invest, They can put up gates to the extent that you cannot redeem if things go wrong. And so a lot of large hedge funds that almost went bankrupt in late 2008 when we were within 24 hours of bank machines not working, a lot of those large hedge funds put up the gates and did not let people redeem for a couple of years. Startup hedge funds obviously could not do that. And this allows them to be longer term focused. Okay. Next up, Manas wrote, one of my newest courses on AI tools has now been the highest rated on Udemy. As always, big gratitude to you for all the support. Also, thank you for everything. Thank you so much, Manas. You inspire us all. Yeah. And I still have that book you wrote a couple years ago here in my office called Bonds Before Business. Yeah. And if anybody on this call wants to take their career to the next level, I humbly recommend writing a book. And it's really easy to do. And I have a template for you as well if you want. And you can access that template from my website. And I'll show you exactly where. And I don't ask for your email or anything. So what you do is you go to Haroun, wish I could spell my own name, harounmba.com/book. And you can download it from here. Here it is, yeah. So you can download the book here, and you could give the book away for free to people when you're doing your networking meetings. It's easy to do. And what I do with my first book, actually, and again, it's free to do. With my first book, which is called 101 Crucial Lessons They Don't Teach You in Business School, what I did was I wrote one article every week for 2 years on LinkedIn. And so I had 104 chapters. And I threw it together into a book. I repurposed that content. And you can also repurpose all of your content in terms of not just LinkedIn articles, but also YouTube vlogs, TikToks, Instagrams, etc. And imagine going to a meeting and giving somebody a book that you wrote, an informational meeting. And if you think that's too much work, ask yourself, how badly do you want that job or that customer? Anybody can do it. Now, in this template, you can download at the aforementioned website I just spoke about. There's one page of instructions on how to publish this directly on Audible, as well as Kindle and Amazon Print. Yeah. All right. And then Simon, who goes by Scatter. Simon, great to see you. And thanks again to your mother for that wonderful advice she gave me 2 years ago on this weekly call. Simon wrote, do you think a reverse recession is possible? That's a double negative. I don't know what that means. If you're talking about a bull market to the extent that GDP grows, I think what's going to happen is next year the economy is going to slow so much that the Federal Reserve is going to be cutting interest rates. And we know that's coming, interest rate cuts, eventually, because there's 3 economic data points that came out that indicate that we might be going into a recession, or at least they might be cutting rates. And I mentioned that earlier. Those 3 data points are as follows. Number 1, inflation is a bit lower now. It's getting better. Number 2, unemployment is ticking up. And lastly, number 3, or threeth, as my son Andrew used to say, you've got retail sales were down last month for the first time since March of this year. Okay. Next up, Manas wrote, why is Canada ruled by father-son? You know who I'm talking about, your very old friend who took the girl away from your conversation, and how are Canadians so cool all the time? Yeah. So Manas is referring to Justin Trudeau, whose father, Pierre Trudeau, was prime minister forever when I was a kid. And I went to school with Justin as well. I'll tell you the story about the girlfriend thing. I mentioned this a long time ago. But I was at McGill University, and it was my 4th year in 1994. And there was this girl that was so beautiful that nobody ever talked to her. And so it was my last year. And I said, screw it, let's do it. I'm just going to go up to her and talk to her. And it was an on-campus event, a charity event. And she was standing there. And I went up to her, and I introduced myself. And we were talking for like half an hour. And I was like, oh my gosh, I have to ask for her number. This is crazy. And she was laughing at my jokes. And you all know how awful my jokes are. And then this guy walks up. He looked like Jim Morrison. He had long hair. And he started talking to her. And she turned her back to me. And I was like, WTF? Why the face? What's going on here? And I couldn't understand what was happening. This guy's jokes were worse than mine, and my jokes are brutal, as you know. So I didn't know what to do. And so I looked at the guy and I said, "Hi, I'm Chris Haroun." Like I'm nobody, you know? And he said, "Justin Trudeau." And I'm like, "Dude, I just got Heisman by a Kennedy. I can't compete with that." Yeah. But he was very nice, yeah. Okay. All right. And then Manos wrote, "Canadians are probably the happiest of being ever. How is that?" I don't know. I guess I'm a very proud Canadian. We tend to be very self-deprecating. We laugh at ourselves. We're raised to be humble as well. Wayne Gretzky, who's my hero. He's the quintessential Canadian hockey player. Of course, every Canadian has to have a hockey stick in their office. He once said this: "When you lose, say nothing. When you win, say even less." I love that. Okay. And then Simon wrote, also a reminder regarding EduTech, Middle Eastern Saudi metaverse investments are going to mature soon. Yeah. And then you wrote, "Yes, that's my view also in terms of the outlook for the economy next year." Yeah. Excellent. All right. On that note, I'm going to wrap up this week's webcast. Thank you so much. Thank you so much, Karen, as well, for that unbelievable interview. And remember, everybody, your network is your net worth, and relationships are more important than product knowledge. And I'm going to end this webcast like I always do with this video that I licensed. It's a Steve Jobs interview that will change your life. Thank you, everybody, and God bless.
When you grow up, you tend to get told that the world is the way it is, and your life is just to live your life inside the world, try not to bash into the walls too much, try to have a nice family life, have fun, save a little money. But life, that's a very limited life. Life can be much broader once you discover one simple fact, and that is everything around you that you call life was made up by people that were no smarter than you. And you can change it. You can influence it. You can build your own things that other people can use. And the minute that you understand that you can poke life and actually something will, if you push in, something will pop out the other side, that you can change it, you can mold it, that's maybe the most important thing, is to shake off this erroneous notion that life is there and you're just going to live in it, versus embrace it, change it, improve it, make your mark upon it. I think that's very important. And however you learn that, once you learn it, you'll want to change life and make it better, because it's kind of messed up in a lot of ways. Once you learn that, you'll never be the same again.